If you look at the road these pension funds have been going down for the last, actually, several decades, I mean, that decision I don't think will impact that model.
Right.
Now, I think we are in desperate need of reform on the pension front because I think the current model has proven to be a prescription for mediocrity. Tampa, the Fire and Police Fund, has been the antithesis of that.
Right.
They've done it just the opposite way, and what's interesting about
explain what you've done.
Well, they only have one manager. We've been the sole manager for 43 years, and the fund has gone from $12 million to over $2 billion, and they've taken out over $1 billion. It's compounded at 12% since inception, the total fund.
That's kind of unbelievable for a pension fund. I mean, we talk all the time about how pension funds are looking for maybe 7% annualized growth, and maybe that's a little too lofty for some of them, that they should be really taking down numbers. How do you hit 12%?
Well, you know, if they make these reforms that I think they should make, I don't think it's unrealistic, a 8-9% number for assumed rate of return. What we've done, we've had the luxury, it's been an extremely dedicated board for 43 years. They've given us the luxury, believe it or not, of taking a 20-year investment approach, which is very unusual. We like the 20-year because in the study we did, there hadn't been a 20-year period that has not included a bull market and a bear market and a recession and a speculative bubble and a war. So we think that's a great time frame to measure the competency of a manager. The other thing is the actuaries like 20 years because it's a great snapshot of a public service employee, fireman, policeman, right. So it kind of matches up.
When you take a 20-year time frame, what does that allow you to do? What investments can you make that you couldn't do otherwise?
Yeah, it's a luxury. Yeah. It's a luxury. We're not being jerked around by an asset allocator trying to shift into, I call it, it's a multi-layer, multi-fee, multi-manager model. The other model. Mm-hmm. Tampa is one manager with a high-quality, long-term approach. We're top-down and thematic, and so we can really look ahead.
But just for an example, what's one investment you might be able to make that other pension funds wouldn't be able to?
I mean, there have been several over the last 4 decades. I mean, my father forged a relationship in the early 70s, but I mean, the decisions that we made in the late 70s and early 80s, going back that far, when Paul Volcker came in on the monetary front, and when Reagan came in on the fiscal front and the regulatory front, we decided that inflation was going to be coming way down. So, in other words, we were able to overemphasize consumer staple names that had flatlined, and we were able to really look out, you know, the Coca-Colas and the Gillettes of the world. Right. In the early 2000s, when China joined the WTO, it was more a focus on the commodity situation, what that was going to mean for global commodity prices. Right now, looking out over the next 20 years, we're big believers in the 4th Industrial Revolution. We think that's going to impact, particularly on the capital spending front. And I'm talking about artificial intelligence and blockchain and robotics and automation, industrial automation, 3D printing.
How concentrated is your portfolio?
We've got about 60 equity names. It's a high-quality, balanced approach. The stocks are used for capital appreciation. The bonds are used for income and stability. And we've got about 60 names.
Look, you've gotten it right, but the question is, the idea of a pension fund handing all their money to one manager, does that truly make sense to you across the board? Meaning,
well, the other consultant-driven multi-manager model has been a prescription for mediocrity. They're operating off of a flawed modern portfolio theory playbook based on regression analysis.
If I pick the wrong manager, and if I put all my eggs in one basket, what's going to happen?
Well, if you let them, there are plenty of high-quality managers out there. And the advantage of having one high-quality core manager is that, number one, the fees, this current model that so many pension funds are using, the multi-layer, multi-manager, multi-fee model, I mean, if you take a $5 billion public pension fund and you return 7% instead of 7.5%,
right.
Over 20 years, that's $1.9 billion less money for these pension funds. And I say that because the average fee for these public funds is 58 basis points. So you're going to be helped on the fee side. You're also going to be helped because you're not going to be gyrating from an asset allocation standpoint, letting the manager focus on the long term.
How would you feel about just letting it ride on index funds? Sort of
Absolutely. Absolutely. That would be far superior to the current model. I mean, right now, if you look at the asset allocation decisions these funds have made, precisely at the wrong time, they've reallocated. You know, in the late 90s and early 2000s, there was this huge push towards tech stocks right at the wrong time. In the mid-2000s, everybody wanted to be Yale. There was a huge push to alternative investments right at the wrong time, hedge funds and private equity. Since, I mean, this is the 10th year of this bull market. We've compounded at 15% a year, but yet public funds have been reducing their equity exposure. Again, right at the wrong time. Now, why is that? I mean, I think I know why it is. Right. There's a third party in there controlling the asset allocation, and they're being jerked around instead of taking a high-quality long-term approach. But indexing, absolutely.
Right. Let me ask you a final question. If I double or tripled the amount of money you had under management, do you think you could have the same kind of returns?
Our approach wouldn't change. Absolutely, our approach wouldn't change in terms of focusing on the high-quality, long-term thematic approach. So I would think it would approximate. Yeah, I don't think that would be a big issue.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.